I guarantee you a life of happiness.
Guarantee you. Once you've been guaranteed, there's nothing else that matters, right? So put jump for it. However, the way that you access this cash from your policy is by borrowing mostly. And when you borrow that money from your whole life policy, what do?
They charge you an interest.
They'll charge you interest, which is how much? 8%.
Son of a twang, guys.
Your permanent life insurance, there's two types of permanent life insurance. You talk about whole life. Whole life is one type of permanent life insurance, right? There's been whole life, and then there's universal life.
Okay.
Right? So whole life is the first and the oldest kind of permanent life insurance, right? And that is where the insurance company would essentially say, if you want $100,000, you pay us $100 a month, right? Of that $100 a month, we're going to give you, a portion of your premium will go towards paying for the $100,000 insurance, and then a small portion will go into your cash value accumulation.
Okay.
And that cash value, we declare that will pay you 4%.
Okay.
And for the most part, that's what it was, between 3.5% and 4%.
Okay.
4.5%.
Okay.
They would pay you in interest every year.
Okay.
Right? And those are the oldest kinds of policies, right? Now, you'd carry that the whole life policies go until age 100. Okay? So, after having a 10, 20, and the reason why this happened is because the industry realized that people are outliving their term life policies.
Yes.
Right? So they came in with a whole life. Now, the whole life, it worked when it worked, but then again, people started realizing that, they're paying a lot of money for, you think about it, $100,000 term life might cost you $15 a month. $100,000 whole life will cost you $100 a month.
Let's use the 1 million number, because I think I like the 1 million number from the example that we gave.
Okay.
And for more realistic purposes.
We'll come there.
Yeah.
We'll come there. With a whole life, for the most part, they were the biggest whole life policies we've seen. They're 6-figure numbers,
Okay.
right? They've not crossed the 7-figure, right? Unless for very, very well, because they were in all honesty, they were very expensive.
Okay.
Right.
Okay.
So very few people, and most people that have whole life policies have $10,000, $15,000, $20,000, and they're mostly the shows who the guy would come and knock at your door and present you, say, oh, if you die, we guarantee you get $10,000, and right.
Okay.
And so they pay $20, $30 a month for $10,000.
Okay. So whole life policies are typically lower.
They are lower because of the expense of it.
Okay.
And they were mostly geared towards your final expense.
Okay.
There's also the aspect of growing some cash in it.
Yeah.
And there are people who have grown some decent cash in it.
Yeah.
Paying little money, but paying it for years. I've encountered people who were able to cash out, $10,000, $20,000, $30,000 from their whole life policies.
Okay.
But those whole life policies stopped becoming very viable because the expense ratio is very
high.
Right?
Okay.
So they would guarantee you 4% interest. And the thing about people is we like that word guarantee.
Yeah.
When I guarantee you 4%, you're all for it.
I guarantee you a life of happiness.
Guarantee you. Once you've been guaranteed, there's nothing else that matters, right? So put jump for it. However, the way that you access this cash from your policy is by borrowing mostly. And when you borrow that money from your whole life policy, what do?
They charge you an interest.
They'll charge you interest, which is how much? 8%.
Son of a twang, guys.
Right?
Robbing from Peter to pay Paul.
So that you're borrowing, you're saving at 4,
and borrowing.
When you borrow from yourself, you're borrowing at
8.
At 8. So slowly but surely, that's stopped to become because I've encountered people who went and have been told, hey, your interest owed on the loan you've taken out against your policy is not allowing this policy to be viable anymore. You need to either increase your payment or you lose the policy.
So you can't just cash out, I'm just taking my cash at no cost.
You can take your cash, you can surrender the policy.
Okay.
Right? At a point and say, hey, I just want my money back now.
Yeah.
And I'll be done with it.
Yeah.
And that is possible. Right? And that is very possible. So now the industry again realized that, hey, there's something that we can do. Because these guys are always thinking. Right? The industry, the bigwigs and whoever their people are always thinking. So they came up with a universal life.
Okay.
Right? And I'm going to fast forward to 20, 25 years ago, where they came up with something called the Index Universal Life. That's what you're talking about, the IUL.
Okay.
Okay?
All right.
And so what does the IUL do? They came. Let me go a little bit before that. So there was the Universal Life. Universal Life also, offered you an interest rate, but the expense ratio was a little bit high, right? So people, they kept on thinking, so they brought the Variable Universal Life. The Variable Universal Life was where you had insurance with an investment portion. That portion invested straight in the market. When the market went up, you went as high as the market, but when the market crashed,
it crashed.
You also
market.
it crashed the market.
Yeah.
They came back to put on their thinking caps again, and they said, okay, let's do something else. So they came up with something called the Index Universal Life. This product is about 25, no more than 30 years old. And what they did with the Index Universal Life is they took the best of both worlds. They said, here, what we're going to do, we're going to give you your insurance, okay, and say, let's talk about the $1 million life insurance plan.
Yes.
45. Today I was dealing with a 40-year-old lady. 40-year-old lady. 40-year-old gets $1 million, right? And her monthly premium is $1,000.
Okay. So 1% is a good ballpark,
right?
For I mean, I know there's other factors involved, age and all that, but 1% is a good ballpark, just to estimate.
Give or take.
Yeah.
Right? So 40-year-old.
Actually, that's not 1%. 1,000, 1 million. It's 0.1. 0.1%.
Yeah. So she pays $1,000 a month, right?
Yeah.
Out of her $1,000 a month, that's $12,000 a year.
A year.
Right? Let's say that about $4,000 goes towards paying for the life insurance.
Okay.
So remember that example I gave in the beginning.
Yeah.
You give this company a little bit of money, $4,000 a year, right? And they guarantee your family what? $1 million.
Yeah.
To me, I think it's a fair deal. In the beginning, it might not be, right? But then, hey, $4,000, a lot of people say, okay.
So wait, where's the $4,000 coming
You're
from?
paying $1,000
yeah.
every month.
Every month, yeah, that's
$12,000 a year, right? Out of that $12,000, they're taking $4,000, give or take, and they're eating that.
Yeah.
That's the cost of the $1 million.
That's a sunk cost.
Right.
Yeah.
And then out of that 12,000, the difference goes into a savings.
Yeah, a kind of an index savings.
It's an index savings.
Okay.
It's not an investment.
Yeah.
Okay? It's a savings. And what they do is that they index, they mirror the returns of this to an index. And these companies, insurance companies, have more money than Arab Nani.